banks that let you invest in the stock market.
I know I can turn that money into more money.
This guy's talking about is opportunity cost. You only lose by saving, and that simply isn't true. Hi guys, in today's video I'm going to be reacting to TikTok not investment advice. Just before we jump in, I'm not making any claims or comments on the veracity or the truthfulness of any of the videos I see. I'm just expressing my opinion on what I see, and it is my own personal opinion. I have to build those legal walls before all the cease and desist letters start coming in. Cool, so let's make a start then. Do is go onto TikTok and look for hashtag investing and see what comes up.
I was a financial advisor for 4 years,
so he should know what he's doing.
I've done this a time or two. Let me show you exactly how to start investing. Step 1 is to choose a broker. Think of them like banks that let you invest in the stock market.
I mean, I suppose that's one definition of what a broker is. It's not quite accurate though, and there's quite a lot of regulatory differences between a bank and a broker specifically. So remember, what a broker does is it's kind of like a middleman. They facilitate the trading of stocks and other asset classes. So for example, if I want to buy a stock, I go through my broker who then gives me a price. I then accept or reject that price, and they then facilitate that on the market to a third party who is willing or able to sell at that set price. Error here, which actually goes back historically to what we call the Glass-Steagall Act. Now, this was an act that came out in the wake of the Wall Street crash, and what it said is that commercial banks have to be separate from investment banks. So what the guy's kind of saying here, like, oh, it's like a bank but for trading, I suppose in a very simplistic world maybe, but in reality they're very different. Also, your choice of broker is really, really important if you're investing. I don't know this one, I've never come across them before, so I can't comment on this one particularly, but oftentimes when we see free brokers, what we often see is that brokers will charge you in ways that are a bit less transparent. So for example, they might charge you what is called a spread. A spread is a difference between the price that they buy the share at and the price at which they offer to sell you the share at. So they basically can make a little difference there. By offering those spreads, they can make a profit. The other reason why it's really important when you're choosing a broker to be careful is firstly because you want them to be regulated, because that protects you and it also protects them. And additionally, you're going to want to make sure they're going to work all of the time. There's no point you holding a share in a brokerage account and then that share goes to the moon and then you can't cash out because the brokerage account is broken or it's not working. So you really do need to be careful when choosing the brokerage that you're going to be using. Let's see what else he's got to say.
Now to buy a stock, you click on the markets tab and you'll find this screen. Click on this magnifying glass. We'll use Tesla for our example, so we click this first.
This is very true. So when you do search for a stock, oftentimes there'll be multiple options for that stock or multiple different funds that might track it, or even completely other businesses that just have a similar ticker. So what he's typed in there, as it says, actually is ticker. So that is the code that's assigned to a business for you to be able to find their stocks on the stock market. But you do have to be very careful when you're buying and selling stocks that you're actually selecting the right ticker.
And that's exactly how you can start investing. Reminder to use my link in bio to start your investing journey with a couple free stocks.
It's interesting at the end that he's put as a disclaimer it's not financial advice, but then as kind of a claim to credibility at the beginning of the video, he says, I used to be a financial advisor. Yeah, I'll let you make your own minds up about that one. Let's go on. Let's have a look at a different one.
The only video you need to watch and save to start investing your money and start building your wealth. I'm going to go over everything you need to know step by step and dumb it down as if you're a third grader. And if you're anywhere between 15 to 25 years old and you're not doing this, then listen up. It only takes 30 minutes and we'll...
Just to think on the whole dumbing it down, I mean, Einstein very famously said, if you can't explain it simply, you don't understand it. And that's something that I try and live by with the channel and more broadly in terms of everyday life. I don't think stuff should be overly complex. This idea, though, of explaining some of these things to a third grader, is a little bit problematic. One is because if you're trading and if you're making investment decisions, it's often in your best interest to be of an age where you can make responsible decisions and you can make consenting decisions. And third graders obviously are not able to do that. Yes, I think there's power in information, but also we should be reasonable in our expectations, especially around vulnerable people in terms of with investing. Yeah, the rest of that was just a demonstration of the platform. So let's go on to the next one.
When you make your first million, you won't want to stop there. A few years ago, I said I'd quit trading.
I can't. Okay. We can do this.
And I made 2 million. 2 years after I started trading, I ended up making that. But then once you get to that number, you'll want more. Not because you need more money, it just becomes more of a sport at that point. Once you make a few million, you'll then target 10 million because you want 8 figures. It's basically just a never-ending cycle. I hate spending money purely because I just don't want to see that number go down. Every time you make a big
I'm getting real like American Psycho vibes here.
purchase, it delays your next target. When I cash out crypto, it's always with the intention of buying back more at a lower price. I would honestly be happier in life if I spent more because you really don't need millions, especially at my age. But I just can't because I know I can turn that money into more money. This is like a video game to me.
So what's interesting there is actually we do get a little bit of economics theory sort of slid in there in terms of what this guy is talking about is opportunity cost. Okay, so he talks about selling the Bitcoin to buy back later when there's a dip. And that is backed by economic theory. So if, for example, you're holding an asset and you're long on that asset, what that basically means is if that asset declines in value, you should always buy it. The reason why you should always buy it is because opportunity cost is the cost of the next best alternative foregone. Okay? When you're holding an asset, what you're basically saying is, I believe this asset is undervalued. Therefore, if the asset ever does decrease in value from the price you paid, you should continue to buy that asset. Your initial thought that that asset was undervalued is true still. And then if you don't then purchase that stock when it's depreciated in value, you are losing out. So it's the option foregone. And what's interesting is how humans tend to violate this assumption. They don't act necessarily in ways that are entirely irrational.
Change your entire financial future. People usually just give up when it comes to investing because it seems so confusing. So here is a guide to get you going in less than 1 minute. Firstly, you need to choose an investment platform. Gone are the days where you have to call up a stockbroker to invest. This isn't Wolf of Wall Street. You just literally need a phone. Secondly, you need to open a stocks and shares ISA, which allows you to invest up to £20,000 per financial year. You won't get taxed a penny on any growth, or if you decide to withdraw the entire lot, there'll be no tax implications. And lastly, just pick an index fund to invest in. That's just a word for a group of stocks. As you can see here, there's plenty to choose from, but do not be paralyzed by choice. You can't go wrong with a low-cost, globally diversified fund because it spreads your risk and you're not investing in one company. Now, just automate a monthly payment and do not look at the account every day.
So it's better than some of the other ones. One thing I would say is the guy kind of says, oh, just pick your platform. There's a bit more to it than that, and the terms and conditions are quite important because the platform you're using actually affects the rights you have as a shareholder. So some platforms, for example, allow you to vote and allow you to exercise your full rights as a shareholder, whereas other platforms don't allow you to do that. And that's to do with the structuring of the platforms, because oftentimes what they do is they hold your stock in a trust, which is separate from their brokerage. That way, if the brokerage goes bust, in theory, your stock should be safe because they're held in a separate trust. Shall we look at another one? Oh, go on then.
Oh, go on, man.
Invest in versus saving. Here's what happens to your money when you leave it in the bank. Let's use £1,000 as an example. The average interest rate on a savings account in the UK is about 0.13%.
Not anymore. Oh, it was so done for.
Which means by the end of the year, you would have made about £1.30 on this starting balance. Our total returns would be £1,001.30. Now you might be wondering what the matter is here, and it's this big thing called inflation. We're only looking at inflation rates of about 8 to 10%. Inflation jeopardizes the spending power we have on every pound we own. So what would have been £1 2 years ago is only really about 80 pence today. What does that mean in this scenario? Really, guys, we've got about £80 less in spending power because of this figure here. But we're actually being fobbed off leaving our money in a savings account because that initial balance is only really worth about £920.
So there's a couple of problems here, and actually it plays on a very important part of behavioral economics. Now, you probably have heard of this as FOMO, or fear of missing out, okay? In economics, we call this loss aversion. People are more scared of losing something than they are of gaining something. For example, if I say, do this or you might lose something, you're more likely to do it. Whereas if I say, do this and you might gain something, you're less likely to do it. Do it.
Do it.
And there's a couple of really big shortfalls here to this idea and this strategy, because we make out like saving is purely a loss-making endeavour, like you only lose by saving, and that simply isn't true. For example, what happens if you had invested this money and the stock market actually goes down and you lose money? Now, possibly in the long run you could recuperate that loss, but what if you need that money in the short run? And this is why saving may actually be beneficial, because it allows you to make purchases in the short run. For example, you could save up in order to put down a deposit for a house, or you could save up in order to put down the initial capital or the sunk costs to start a business, like a YouTube channel or something like that, like you could buy the camera, the microphone, etc. You obviously sacrifice that, and we come back to opportunity cost, when you use that money in the stock market and when you invest it, because there's always a risk of it going down as well as up. I'll give you a good example of this. Me personally, I invested in the company, and that company's main rival went broke, and their stock price did really, really well. It bounced up because of that. But then COVID happened, that business was really badly affected, and that stock has been down about 30% for the last 3 years. So obviously I'm not a very happy boy there, but if I was relying on that money, say, to buy a house or to start a business or just as an emergency fund if I was made unemployed, I would be in a very bad situation. And that is why this trope we have on TikTok, that saving is always bad and you lose all this money saving, can be quite bad advice.
Look at this.
Bloody hell, this has 100,000 likes. No, it has nearly 1 million. I need to start making videos like this. Oh, the pain. Oh, hold on, it's started. We need to go back.
Watch if you want to invest but don't have tons of money. Hi, welcome to investing. How can I help you? I don't have that much money, but I thought I'd try investing. No problem, come on in. We'll just have a little walk around and you can tell me if anything catches your eye. I like Apple. Okay, 1 share of Apple is $150. Oh, I don't have $150 on me. Oh, you can just get a fractional share. You don't need to buy the whole share. Okay, well here's $15. Perfect, here's 1/10 of a share for you. I'll take $10 of Netflix and I guess $10 of Nike. There you go. And where do I go to buy a fractional share? Just click the link in my bio. You'll even get free stocks just for signing up.
Please sponsor me, someone. How much money has she made on this video? I want to know. So, I mean, I'm not going to comment so much on fractional shares, but do be aware that with fractional shares, you do lose certain rights as a shareholder. For example, the right to vote on the progression of the business, or the right to attend shareholder meetings and vote on the direction that the business takes. Now, maybe for most investors, that's not important to them. But if, for example, you are really heavily invested in the business and you've got a long run prospect on that business and you're really interested in seeing that business succeed, by holding fractional shares, you are less able to actually influence the direction of that business. Now, what you could counter and say is, right, I only use fractional shares until I can afford the full share, but the problem is then you're going to incur a lot more costs when you're trading in and out. Let's watch another.
Virtually every millionaire.
I'm enjoying this. I don't know if you are. If you are, maybe consider giving the video a like, maybe a comment. It all helps. Let's have a look at this one.
Virtually every millionaire invests in the stock market, and so should you, because it's a fantastic way to build wealth. But which stock should you buy? You could buy Apple or Microsoft or Google or Amazon or Tesla. In fact, there are actually thousands of publicly traded companies in the stock market. But buying individual stocks involves more risk and volatility. So the best way to guarantee yourself your fair share of all market growth is to buy all the stocks in the stock market in proportion to the size of the company. That's exactly what an index fund does. When you buy an index fund, you're buying all the stocks in a big list. As those companies grow and profit, that value is returned directly to you in your index fund in your investment account. I'm a millionaire and most of my money is invested in index funds.
That's quite a good explanation of what an index fund is. You also sometimes hear these referred to as ETFs, or exchange traded funds. The problem here is, however, is this idea that they're lower risk because you have more exposure, and it's been mentioned in a couple of videos so far, I think. Now, Michael Burry, who predicted the 2008 financial crisis, and he was also played by Christian Bale in the film The Big Short, actually thinks there's a bubble in ETFs. He believes that these index funds are overpriced because what they basically do is they pull up the price of the individual individual shares because everyone's purchasing the fund. And what that then does is means that the actual base value or the real value of those shares in the fund are overvalued. And that can obviously lead to a correction or a fall in that ETF price, or even in the business that it's holding. The other thing to note here as well, we keep banging on about these shareholder rights, but when you hold an ETF, you don't have any rights to exercise because you don't actually hold the asset itself. You hold a share of the fund that's tracking those assets. Now that's important in this case for our millionaire, because what it means is they have no say on the dividends they'll be paid, because dividends are decided at the annual share conference. So for example, if you wanted to get paid more dividends because that business has a high profit level, you can't argue your case. Similarly, if you think those dividends should actually be reinvested into the business to make sure that they're competitive in the long run, you can't argue for that position either. So ETFs are an intrinsic part of investing, but they're not this kind of safe bet that a lot of people try and say they are.
This is how I've been able to buy $40 million worth of real estate without using a dime of my own money in a child's diagram. So what I did, I borrowed money from a private money lender to purchase a distressed property. I borrowed money from that same private lender to rehab said distressed property. So now that the property is fixed up, I got it rented and started collecting rent. Next thing I did, I took the property to a local bank and they gave me a loan to pay back my private lender. I paid him back with the equity that was created on a refinance. Now I owe the bank money, but I take the rent from the renter and pay the bank back. So I'm just using other people's money, and in the end of the day, I own an asset that produces cash and grows in value. You can do this as many times as you want. Follow me, I'll show you how.
Now, a couple of things. What I would imagine is actually that first loan that this guy's borrowing in order to buy that house is going to have an incredibly high interest payment. And that's because he's not talking about a mortgage here. He's not talking about a form of what we call collateralized debt. This is an unsecured mortgage. Now, securitization is basically where we take a loan or a liability and we back it with an asset so that it's safer to the person who's lending you the money. The obvious example of this is a mortgage, because a mortgage is collateralized, and that piece of collateral that backs the loan is the house that you're living in or renting out, depending on the mortgage structure you're using. Now, this guy hasn't got any collateral on the line, or at least he didn't mention that, so that initial loan is going to have a really, really high interest rate. This diagram he's drawn is also strikingly similar to what caused the Wall Street crash. Now, it wasn't property as an asset which caused the Wall Street crash, it was stocks as an asset class which caused it. Now, during the 1920s in America, there was a golden age in economics. This is kind of the time of the Great Gatsby, where there is massive exuberance, massive spending. Industrialists and business people are doing really well. The rest of America, not so much. Then comes along the Wall Street crash in 1929. Now, there's a lot of things that caused the Wall Street crash, and I don't want to have a unifactorial analysis, as in just say it's just one factor. But one thing that did contribute to it was people borrowing money in order to finance the buying of shares. And this is because they were suffering from what we call overconfidence bias. It's also known as the hot hand fallacy. It's this idea that past results can be used to predict future outcomes, and they obviously can't. In fact, this is the disclaimer that's used on most financial websites. It says don't use past results as an indicator of future gains. So, going back to his diagram just briefly, let's say he takes out this initial loan and on this house, okay? Well, what happens if the house price collapses as he does that? Well, then when he goes to the mortgage lender in order to get his money back, they're not going to pay him the money that he needs to repay the initial lender. He's then in what we call negative equity. And this is what happened with the stock crash. People had borrowed this money in the hope of getting it back from the shares. The share price crashed, they couldn't recoup that money, and therefore they couldn't pay back the banks, and then the banks went under. Moreover, we're talking about a macro or a price crash in housing, but what about at the micro level? What if you bought that house, but now no one wants to live in that house? Or maybe that street is less desirable because something has happened there, or because people don't want to live there anymore. There's a lot of things that could potentially go wrong here. And there's a lot of liabilities on the line, because as we said, you have to pay back that loan, or it's going to have very, very high interest rates. And if you don't pay it back, that could be crippling debt that you get yourself into. Now, of course, borrowing can be used as a way to leverage your money and to get higher returns, but you need to be very, very careful when you're doing it. The other thing to mention with that first loan is who is going to lend you the amount of money to be able to buy a house without seeing, for example, that you have a good job or that you have a high earnings, because they're going to want to see that you're going to be able to pay back that loan. They're not going to hand this out to anyone. There's going to be high levels of credit checks. Oh, we're on mute. Keep doing that.
How to invest when you've got just $50. Step 1 is to open up an investment account with any of these companies here. Step 2 is to invest $50 to $100 in any of these stocks or ETFs. Step 3 is about setting up a recurring payment into your investment account every single month so you create the discipline to invest regularly and build your money momentum.
So again, if you've only got £50, so there's two ways you could look at this. Maybe this is £50 after you've paid into, say, an emergency fund, or you've met all your obligations, etc. Let's view it as the best way there. But in all honesty, if you have £50 spare, maybe the best thing isn't to invest it. It could be to develop that emergency fund, as we said. Now, everyone keeps going on about a recession. If a recession actually bites, a lot of people are going to lose their job. If you lose your job and all your money's tied up in the stock market has gone down in value. So it's very difficult for you to pull your money out of the stock market without making a loss. So maybe for you, the best thing to do with that £50 is to actually save it for a rainy day or save it towards an emergency fund. Then once you've met that obligation, you can then look into investing in the stock market. I also love the comments and the reply. So someone said, my biggest worry is stocks crashing and losing all my money. To which the person has replied, if you buy the right ones, going to zero is close to impossible though. Now, I don't think this really assuages what this commenter was worried about, because I mean, if my stock portfolio is down 50%, I'm going to be pretty annoyed anyway. Like, it doesn't matter if it goes to zero. That's going to be pretty bad. The other thing is also, this fallacy just isn't true. This buys in, again, to this idea of too big to fail. This idea that some businesses will always be there and they're never going to crash or have problems. We've seen this time and time and again. Most famously, Lehman Brothers in 2008. That was an institution, a banking institution that had been around for hundreds of years, and yet they crashed. People, when it was crashing, did not believe that it was possible for Lehman Brothers to crash. So this idea that you just have to choose the right ones is really not correct. Stocks are very risky. They're one of the riskier forms of investing, and that is something that I think people should be aware of. So thank you so much for watching, guys. If you enjoyed this video, let me know, because I'm considering maybe doing a part 2. And do please consider supporting me on Patreon. You get exclusive access to Q&As with me and also exclusive content. But yeah, have a great weekend, guys, and I'll see you all in another video.